You don't lose in trading because the market is against you. You lose because you keep fighting yourself. The real difference between those who win consistently and those who don't, it's not strategy. It's not indicators. It's something far more uncomfortable, and most traders will never face it. Let me tell you something most traders don't want to hear. Winning more and losing less has nothing to do with finding the perfect setup. The truth is brutal. You already know enough to be profitable. But knowledge isn't your problem. Execution is. The real secret lies in how you behave under pressure. Can you hold your winners when every instinct tells you to close? Can you accept losses without revenge trading? Can you stay disciplined when your emotions are screaming at you to do the opposite? Because in this game, the market doesn't beat you. You beat yourself. And until you master that, nothing changes. Most traders think the market is their biggest challenge, but that's not true. The real battle begins the moment you enter a trade and your emotions start to take control. Pressure builds instantly. Your heart rate changes, your thoughts become louder, and suddenly every tick on the chart feels personal. This is where most traders lose, not because they don't understand the market, but because they can't manage themselves. When a trade goes against you, fear kicks in. You start questioning your decision, even if your setup was valid. Instead of sticking to your plan, you hesitate. You move your stop loss, hoping the market will turn back in your favor. You tell yourself a story to justify staying in the trade longer than you should. And before you realize it, a small controlled loss turns into something much bigger. This isn't a strategy problem. It's an emotional reaction. On the other side, when a trade goes in your favor, a different emotion takes over. Fear again, but in another form. The fear of losing unrealized profit. You see green on your screen, and instead of trusting your plan, you rush to close the trade too early. You grab a small win, feeling relieved, but deep down you know you didn't execute properly. Over time, this behavior destroys your edge because your losses remain large while your wins stay small. The market exposes everything about you. It reveals your impatience when you enter trades too early. It exposes your lack of confidence when you exit too soon. It highlights your ego when you refuse to accept a loss. Trading is one of the few environments where your internal weaknesses are reflected instantly in your results. Mastering your emotions under pressure doesn't mean you stop feeling fear or stress. That's impossible. Even experienced traders feel it. The difference is they don't let those emotions dictate their actions. They have rules, and more importantly, they follow them, especially when it feels uncomfortable to do so. You have to learn to act against your natural instincts. When you want to close a winning trade too early, that's often the moment you should hold. When you feel the urge to move your stop loss, that's exactly when you should leave it alone. When you're tempted to jump into a trade out of boredom or frustration, that's your signal to step back. Discipline is not about doing what feels good. It's about doing what is necessary despite how you feel. This is where real growth happens. Not in finding a new indicator or strategy, but in building the ability to stay calm and execute under pressure. It requires awareness. You need to recognize what you're feeling in real time and understand how it influences your decisions. Without that awareness, you'll keep repeating the same mistakes. In the end, the traders who win more and lose less are not the ones with the best systems. They are the ones who can control themselves when it matters most. Because the market doesn't need to defeat you, you'll do that on your own if you don't learn how to manage your emotions. Cutting losses quickly sounds simple, but in reality, it's one of the hardest things a trader will ever learn to do. Not because it's complicated, but because it goes directly against human nature. Nobody likes being wrong. Nobody enjoys taking a loss. And yet, this single skill is one of the biggest differences between traders who survive and those who slowly destroy their accounts. The moment a trade starts going against you, your mind begins to negotiate. You tell yourself it's just a temporary pullback. You convince yourself the market will come back. You start looking for reasons to stay in the trade instead of reasons to exit. This is where the damage begins. Because the longer you hesitate, the more control you give to hope instead of logic. Hope is not a strategy. It's an emotional escape. It allows you to avoid the discomfort of admitting you were wrong. But the market doesn't care about your comfort. It doesn't reward hesitation. It punishes it. A small loss that could have been managed quickly turns into something much larger, not because the market moved too far, but because you refused to act when you should have. The truth is, taking a loss quickly is a sign of strength, not weakness. It means you respect your rules more than your ego. It means you understand that being wrong is part of the game, not something to avoid at all costs. Every professional trader knows this. Losses are not the enemy, uncontrolled losses are. When you cut a loss early, you preserve more than just your capital. You protect your mindset. A small loss is easy to recover from, both financially and emotionally. But a large loss creates frustration, anger, and the urge to get your money back quickly. That's when traders start revenge trading, taking impulsive setups, and making even bigger mistakes. One bad decision leads to another, and suddenly it's no longer about trading, it's about emotion. There's also a deeper psychological shift that needs to happen. You must stop associating losses with failure. A loss doesn't mean you made a bad decision. It simply means the market didn't do what you expected this time. Even the best setups fail. Even the most experienced traders take losses. The difference is they accept it instantly and move on without hesitation. Discipline is tested in these moments. It's easy to say you'll follow your stop loss when the market is calm and you're not in a trade. But when real money is on the line and the market is moving against you, everything feels different. That's when your true habits take over. If you haven't trained yourself to act decisively, you'll fall back into hesitation. You need to build the habit of exiting without thinking twice. No second guessing. No moving stops. No waiting for confirmation that you're already wrong. Your plan should define your risk before you enter the trade, and once that level is hit, you're out. Simple. Not easy, but simple. Over time, this behavior compounds in your favor. Small, controlled losses become just another part of your routine. They no longer affect you emotionally. And because your losses are kept small, your winning trades have the space to grow and outweigh them. At the end of the day, traders don't blow up because of one bad trade. They blow up because they refuse to accept small losses. If you can master the ability to cut losses quickly without hesitation, you eliminate one of the biggest threats to your success. Because in trading, it's not about being right all the time, it's about making sure that when you're wrong, it costs you as little as possible. Letting profits run without fear sounds easy when you're not in a trade, but the moment real money is on the line, everything changes. You enter a position, it moves in your favor, and suddenly a new kind of pressure appears. It's no longer about being wrong, it's about not giving back what you've gained. And that pressure is what causes most traders to sabotage their own success. As soon as a trade turns profitable, your focus shifts. Instead of thinking objectively, you start watching every small movement. A tiny pullback feels like a threat. A few ticks against you feel like the beginning of a reversal. Your mind starts imagining the profit disappearing, and that fear becomes stronger than your original plan. So you close the trade early, locking in a small gain, and tell yourself it was the smart thing to do. But over time, this behavior quietly destroys your performance. Because while you're taking small profits quickly, your losses are still happening as planned, or worse, sometimes larger than planned. The math stops working in your favor. You might win often, but you don't win enough when it actually matters. The few trades that had the potential to make a real difference are cut short because you couldn't tolerate the discomfort of staying in. This is the paradox of trading. To make more money, you have to be willing to feel uncomfortable for longer. You have to sit through pullbacks, uncertainty, and moments where it looks like the market might turn against you. That doesn't mean holding blindly without a plan. It means trusting your predefined rules and allowing the trade enough space to develop. Fear in profitable trades often comes from a lack of trust, either in your strategy or in yourself. If you don't truly believe in your edge, you'll constantly look for reasons to exit early. Every small fluctuation becomes an excuse to get out. But if you've tested your approach and you know it works over time, then your job is not to interfere with it. Your job is to execute it consistently. There's also an emotional attachment that forms when a trade is in profit. You start thinking of that unrealized gain as something you already own. So when the market pulls back, it feels like you're losing money, even though the trade is still valid. This perception creates anxiety and pushes you to secure the profit before it disappears. But the market doesn't work that way. Profits are never yours until the trade is closed, and trying to protect them too early often leads to smaller outcomes. Learning to let profits run requires a shift in mindset. You have to stop focusing on individual trades and start thinking in terms of a series of trades. Not every position will become a big winner, but the ones that do are what drive your overall profitability. If you cut them short, you remove your own advantage. You also need clear exit rules. Letting profits run doesn't mean hoping for the best. It means having a structured way to stay in the trade as long as the conditions remain valid. Whether it's a trailing stop, a target level, or a change in market structure, your exit should be based on logic, not emotion. In the end, the traders who succeed are not the ones who take profits the fastest. They are the ones who can sit with uncertainty and allow their winners to grow. Because one strong, well-managed winning trade can outweigh multiple small losses, but only if you have the discipline to stay in it long enough for it to matter. Discipline over impulse sounds like a simple idea, but in trading, it is where everything either comes together or completely falls apart. The market constantly tempts you to act without thinking. Prices move fast, opportunities seem to appear out of nowhere, and there's always the feeling that you might miss out. This is where impulse takes control, and more often than not, it leads to poor decisions. Impulse is driven by emotion, not logic. It shows up when you're bored and want action, so you enter trades that don't meet your criteria. It appears after a loss, when frustration pushes you to jump back in just to recover what you've lost. It even shows up after a win, when overconfidence convinces you that you can't be wrong. In every case, impulse pulls you away from your plan and into reactive behavior. The problem is that impulse feels good in the moment. It gives you a sense of control, a feeling that you're doing something instead of waiting. But trading isn't about constant action. In fact, the best traders spend most of their time doing nothing, waiting for the right conditions. That patience is uncomfortable, and impulse is the escape from that discomfort. Discipline, on the other hand, is quiet. It doesn't seek excitement. It doesn't chase every movement in the market. It follows a clear set of rules and sticks to them, regardless of what is happening in the moment. Discipline means you only take trades that meet your criteria. It means you respect your risk limits. It means you exit when your plan tells you to, not when your emotions demand it. The gap between knowing what to do and actually doing it is where most traders struggle. Almost everyone understands the importance of having a plan. They know they should wait for high probability setups, manage risk, and stay consistent. But when the market is live and emotions are high, that knowledge often disappears. Impulse takes over because it's easier in the moment than staying disciplined. What makes discipline difficult is that it often feels wrong. When you're waiting and not trading, it feels like you're missing opportunities. When you follow your stop loss, it feels like you're accepting defeat. When you hold a winning trade according to your plan, it feels like you're risking giving back profit. Discipline requires you to act in ways that are uncomfortable and sometimes counterintuitive. This is why discipline must be trained, not assumed. You don't wake up one day and suddenly become disciplined. It's built through repetition and awareness. You have to catch yourself in moments of impulse and choose a different action. That might mean stepping away from the screen, taking a break after a loss, or simply reminding yourself of your rules before entering a trade. Another key part of discipline is accountability. You need to be honest with yourself about your actions. If you break your rules, you have to acknowledge it. Not justify it, not ignore it, but recognize it for what it is. Because if you don't, those small lapses will become habits, and those habits will define your results. Over time, discipline creates consistency. And consistency is what leads to long-term success in trading. It's not about having perfect trades or never making mistakes. It's about reducing the number of impulsive decisions that damage your performance. In the end, the market rewards those who can control themselves. Not those who react the fastest, not those who trade the most, but those who can stay focused on their plan when everything inside them is pushing them to do the opposite. Most traders are obsessed with big wins. They're constantly chasing that one trade that will make everything worthwhile, the one that doubles their account, proves they're right, and validates all their effort. But this mindset is exactly what keeps them stuck. Because in trading, success doesn't come from occasional big wins. It comes from consistency, and consistency is built on small, repeatable actions done correctly over time. The problem with chasing big wins is that it changes how you behave. You start taking unnecessary risks. You hold on to trades longer than your plan allows, hoping they'll turn into something massive. You ignore your rules because you're focused on the potential reward instead of the process. And when those trades don't work out, as they often don't, you give back not only your profits, but sometimes even more. Consistency works differently. It's not exciting. It doesn't give you the same emotional highs as a big win, but it builds something far more powerful: stability. When you approach trading with consistency in mind, your focus shifts from "how much can I make on this trade" to "did I execute this trade correctly?" That shift changes everything. Instead of trying to hit home runs, you start aiming for solid, well-executed trades. You follow your entry criteria. You manage your risk properly. You exit based on your plan. Some trades will be winners, some will be losers, but each one is part of a larger system. Over time, this approach creates a smoother equity curve, where growth is steady rather than erratic. Another issue with relying on big wins is that they can create false confidence. You might take a high-risk trade that happens to work out, and suddenly you feel like you've figured everything out. But that success is often random, not repeatable. When you try to replicate it, the results are inconsistent, and eventually the losses catch up with you. Consistency, on the other hand, builds real confidence. Not the kind that comes from luck, but the kind that comes from knowing you can follow your process regardless of the outcome. You begin to trust yourself not because you always win, but because you know you'll do the right thing every time. There's also a mathematical advantage to consistency. If your losses are controlled and your wins are allowed to grow, even modestly, your account will gradually increase. You don't need extraordinary gains to become profitable. You just need to avoid large setbacks and keep stacking small, well-managed results. Over time, those small gains compound into something significant. This approach requires patience. It means accepting that growth might be slower than you'd like, It means resisting the urge to overtrade or take shortcuts. It means understanding that trading is not about proving anything in a single moment, but about performing well over a long series of trades. Consistency also helps reduce emotional stress. When you're not relying on one big trade to succeed, the pressure decreases. Each trade becomes just another opportunity to execute your plan, not a make or break moment. This allows you to think more clearly and make better decisions. In the end, the traders who last are not the ones who occasionally hit big wins. They are the ones who show up every day, follow their rules, and manage their risk with discipline. Because trading is not a game of one big move, it's a game of many small decisions. And those decisions, when made consistently, are what separate long-term winners from everyone else. Most traders are obsessed with predicting what the market will do next. They spend hours analyzing charts, searching for confirmation, trying to be right before they even enter a trade. But this focus on prediction is one of the biggest distractions in trading. Because no matter how much analysis you do, you can never control what the market does. What you can control is how you respond to it. And that's where execution becomes everything. Execution is about following your plan in real time without hesitation and without interference. It's about doing what you said you would do before the trade even started. The entry, the stop loss, the position size, the exit rules, these decisions should already be defined. Your job is not to constantly rethink them while the trade is active. Your job is to execute them as planned. The problem is that most traders don't trust their own plans. So once they're in a trade, they start second-guessing everything. They move their stop loss because the market might turn. They close trades early because they feel uncertain. They add to positions impulsively because they think they've spotted an opportunity. In reality, they're reacting to noise, not following a structured process. Focusing on execution removes that chaos. It shifts your attention away from trying to be right and toward behaving correctly. Because in trading, you can do everything right and still lose on a single trade. That's part of the game. But if your execution is consistent, the results will take care of themselves over time. Prediction gives you a false sense of control. It makes you believe that if you can just analyze better, you can avoid losses. But losses are unavoidable. Even the best traders in the world are wrong a significant percentage of the time. The difference is they don't try to eliminate losses. They manage them. They accept uncertainty and operate within it. Execution requires a different mindset. You have to be comfortable not knowing what will happen next. You have to accept that the outcome of any single trade is uncertain. Once you truly understand that, you stop trying to predict and start focusing on what actually matters, your actions. There's also a level of simplicity in strong execution. It removes unnecessary complexity from your trading. Instead of constantly changing strategies or adding new indicators, you refine how well you follow your existing rules. You become more consistent, more disciplined, and more aware of your behavior. This is where real improvement happens. Another key aspect of execution is timing. Not in the sense of predicting the perfect entry, but in acting at the right moment according to your plan. When your setup appears, you take it without hesitation. When your stop loss is hit, you exit immediately. When your target or exit condition is reached, you follow through. There's no delay, no emotional negotiation, no deviation. Over time, this builds confidence. Not confidence in your ability to predict the market, but confidence in your ability to handle whatever the market does. You know that regardless of the outcome, you'll manage the trade correctly. That kind of confidence is far more valuable because it's based on something you can control. In the end, traders who focus on prediction are always chasing certainty and they never find it. Traders who focus on execution accept uncertainty and learn to operate within it. And that's what separates consistent performance from constant frustration. Because it's not about knowing what will happen next. It's about being prepared to act correctly no matter what happens.